Thanks, Mamlin, for this kind introduction, and appreciate everyone for taking the time out to do this. As Mamlin mentioned, I can't thank you again for taking the time out. And I really hope that you and your family and your loved ones are doing okay. These are not easy times, but I'm confident that this too shall pass. Uh, the last quarter was a very interesting one. When I say last quarter, I'm talking about the September ending quarter because the December ending earnings season is going to start shortly. Why was it interesting? Because there were businesses that were relatively unaffected by margin pressures that came about due to raw material cost increases, or there were businesses that happened to be in our portfolio, despite all of this, which were gaining market share. So in this presentation, we will walk you through first our performance, review the year that just went behind, our learnings in the year. We'll look forward into how is our positioning for the next, I would say, 3 to 5 years. What do we expect from the fund over the same period? And then, like Mabeline mentioned, talk you through as well as answer any questions that you may have. So, like I always do, it's just a good housekeeping practice to look at how did we end the previous quarter call, right? So we've spoken about a few trends that were developing in the market. One was the domestic positioning alongside retail participation, which in effect is actually good for the markets from a long-term perspective. More importantly, we had ended the call last quarter with an expectation from the investor around what they should look at from an equity market perspective. Because from a short term, it looked like there was a lot of trading oriented mindset into the markets. Some part of it some part of it was corrected, some part of it is still not. And end of the day, from a longer term perspective, we were extremely optimistic around where India was and how the earnings trend was going, especially around how our portfolio was positioned. Looking back, right, how did we end the calendar year 2021? So we obviously ended on a strong note with the fund up close to 30% in the year post fees. So this puts our absolute performance since inception of the fund at a cumulative 205%, as against Nifty at 111%. So what this means was an absolute outperformance of close to 93%. And from an IRR perspective, beating the index by a close to 9% IRR. Right? This was always the endeavor for the fund when this was set up in 2017. And I believe our process of investing and focusing on cash flow growth oriented companies will ensure a similar, if not a better consistency as we go ahead into the next 5 years as well. Reason I talk about 5 years is I think every investor and fund manager will at least see one down cycle. And it's important to see these down cycles over and over again in order to show consistency in terms of what you aspire to do from a returns perspective. What does this mean from the money that an investor had put in on day one? 1 rupee would roughly be worth 3.05 today. And from an IRR perspective, cumulatively, when I spoke to you about the returns, from an IRR perspective, the fund has compounded at 25% net of fees, which is what I told you that we want to be continuing to beat the Nifty, which is the index of comparison, by around 6 to 7%. Why do we aspire to do that, and why do we think we can continue doing that? I'll talk you through that in the next few slides. So an important thing to realize about ITIS is we are not the fund that one looks at to keep generating monthly returns or quarterly returns, right? So if someone is looking for that, this is not the place, right? From our perspective, what is consistency? Consistency is where during down cycles, which you're going to see many, right? How do you protect the value and ensure that there is no panic from an investor psyche perspective? So if you look at how we've done during up markets and down markets, right? So from an up market perspective, where we have seen roughly around in the last 5 years, which is around 20 quarters, 15 quarters up market, right? We've beaten around in these up markets, we've beaten the index by around 65% of the time. And our average alpha during these up markets is 1.19%. In the down markets, where we've seen 5 down markets, 5 quarters of negative returns, right? Our average alpha has been 4.02%. So what I'm trying to tell you is, while we have done an IRR outperformance of 9%, most of it has come by outperforming on the downside, rather than saying I'm going to go all in on risk on the upside, because I don't know when a bull market is starting and when it is ending. All I'm in control of is the performance during the philosophy that we follow, right? So it's really important to understand this, because we all like bull markets, and pretty much everyone is aware that over the next 10 years, India should do well. We are primed to do well. And that is a constant theme that's going to emanate. The reason I talk to you about down markets is because I want to take a step back in history and just remind investors what is a bull market, right? See, US went through a decade of outperformance, and this is the which was between 2010 and 2021, right? This is the longest bull market US has ever seen in the last 40 years. And I need to put this into context. This is the longest bull market US has ever seen in the last 40 years, right? And within this bull market of 10 years that we are talking about, US indices, right? I'm not talking about stocks, because stocks are going to be a lot more volatile than the index. US indices fell 20% or more 5 times, right? So what I'm trying to remind you is, while I'm going to tell you that we are optimistic and why we are optimistic, it doesn't mean that we are not going to go through volatility, right? So it's not like everything is hunky-dory, the returns are going to be smooth. And while you want to be participating in the entire India growth story, which we are in the middle of, it's important to ensure through that growth story, your capital appreciates because you manage your volatility during downside. And that's the reason I wanted to emphasize this slide. It's important to also say, okay, it's good that we've compounded at 25%. It's good that we're optimistic in the future, but why do we do this, right? What is the characteristic of the portfolio that ensures outperformance? And why do I always say our process is revolved around cash flow growth, come what may? There could be a thesis in the market saying I'll invest in cyclicals or I'll invest in metals. That doesn't appeal to us. It's not something that we would do. It's not something we're comfortable doing. Why? Because we don't see consistency in cash flow growth. So what we have done here in this slide is to take some of the top 6 exposures of the company. Godrej Properties was a portfolio company in 2017. It's not today. It's an exit. Give you a sense of what our holding period has been in each of the 5 companies that I spoke to you about. Godrej Properties being the 6th one, which has seen an exit. Give you a sense of the short-term cash flow growth, and give you a sense of the holding period cash flow growth. I'll give you an example. So let's take one of our portfolio companies which is doing well, and we've received many questions in the last few months from our investors saying, why are you not exiting when the company has done so well for you in such a short time? And I'll explain why we are not exiting this and how we think about an exit also through the process, right? So let's take L&T Technology Services. We've held this for the last 1.5 years. And I don't foresee anything changing in the short term over the next 1-2 years either. When I say short term, I'm thinking about 4 to 8 quarters. When I say long term, I am thinking about 3 to 5 years, right? So over the last 1.5 years, the cash flow growth of this company has been 84%. When I say cash flow growth, I'm not talking about earnings growth. There's a big difference between earnings growth and cash flow growth. Not all companies, in fact, in India, it's only 5% of the companies, as hard as it may sound, that can translate earnings growth into cash flow growth, right? So while earnings growth is great, that's not what we care about. We look at it, but how many of these companies can translate earnings growth into cash flow growth? And why does it matter? Because if you are running your business, earnings growth is not the raw material that you can reinvest into the business. It's the actual cash that your business generates that you can reinvest into the business. If I have earnings growth that I can't translate into cash and I want to grow my business, then I have to borrow. And that's when balance sheets get inflated, and those are the companies we don't like. It might show you great earnings growth, but if it doesn't show you cash flow growth, there could be inherently a problem during a down cycle, right? So coming back to L&T Technology Services, While the cash flow growth has grown by 84%, what has the returns done? 88%. So what I'm basically trying to tell you is the fundamental returns that are coming through is because of cash flows actually growing. These are companies you want to be holding. You don't want to be selling out just because you're making money, right? This is not a stock or a piece of paper. This is a business that you're talking about. In the last 1 year, cash flow growth has been 107%, right? So you have a typical compounding machine. Does it mean it can do this over the next 7 years? Those are trends that you need to monitor, right? I'm not saying it will do this over the next 7, 10 years. Those are things that you keep monitoring to see, are there tailwinds behind the business? Is the order book good? Is the management reinvesting it properly? But at a fundamental level, if you look at all of the large portfolio sized companies that we own, their cash flow growth as well as the returns that they have generated during the time that we have held this will more or less match. And it coming back to why I mentioned Godrej Properties, right? Which I've always told investors, and if some of them are new on the call, and I continue to reiterate, we are not a buy, hold, and forget investor. We will exit when there is a disparity between cash flow growth and the returns that the market gives us. And that's the ideal example I wanted to highlight was Godrej Properties. This was an investment we did back in 2017. If you remember, that was a period that we went, as a country, we went through RERA and demon and closed times. So most of the real estate companies took a big hit. We wanted to invest in the best brand, which is still continuing to grow its cash flows. Over the 5 quarters that we held the stock, right, the cash flow growth was around 45%, which was not bad during some of the worst times that real estate stocks went through at that point of time. But look at the returns, 200+%. When this kind of disparity happens, there's an opportunity cost in our portfolio. And that's the significance of running only one portfolio, because every investment that you have in the portfolio has an opportunity cost because you're running finite capital. Right? You don't have unlimited capital, and neither do you have the ability to rotate investments between one portfolio and portfolio B and portfolio C that you're running. Right? There's only one portfolio. So at that point of time, you have to take a call as a fund manager saying that, are there better investments which are actually growing, which have an opportunity cost lesser than what you actually own? And that's the reason for the exit, right? So the reason this slide is important to explain to you is when I tell you the cash flow growth of ITIS has compounded at 40% in the last 2 years, what does it even mean? Right? And why are we optimistic over the next 3-5 year cycle that these companies are going to give a similar compounding? Because the cash flow growth is there, right? What happened in the last 5 years, you can break it down through data, but an investor looking at us today should get comfort around the process and why this is a repeatable process, and this should continue in the future, irrespective of down cycles or up cycles, right? Having walked through what we bought and what we sold, now I just want to go over the entire portfolio earnings quality. How does it look today as we speak? Why does it matter? Because an investor looking at us should care about this, should care about what is not doing well in his portfolio and what is doing well in his or her portfolio, right? Here, consciously and deliberately, what we've done as a team is to give you the two-year CAGR of cash flow growth, right? It's very easy to show you the 1 year CAGR and tell you it is an abnormally high number, but that's not the way I would want to look at it, because 1 year is looking at a depressed base. So 1 year will look abnormally high. I don't want anyone to look at that and say everything is hunky-dory. 2 year is basically talking about September 21 to September 19. September 19 was pre-COVID, when things were, we were looking at a normalized phase of earnings across sectors and industries. So when I look at 2 years, we're still growing at a healthy number in terms of cash flow growth. Over the same period, revenue growth, which is the top line growth of the company, is been at around 10.5%. So our portfolio companies have come out much stronger and much better in terms of market share and earnings and revenue growth at a top line level. We've already gone way above COVID, right? So that's again a good sign. Third thing, pricing power of a business is measured according to us through gross profit margins. The higher the gross profit margin numbers, you have the ability to spend on sales and marketing for future growth. So as long as that increases, we are on a good trend. We'd spoken about this in our annual letter. I don't know how many people got a chance to read the annual letter, but if you haven't, no problem. I'll just walk you through some of the trends that we own and why we are optimistic on these trends, and how can an investor easily monitor these trends from a very what I would call macro perspective without doing much work, right? So one trend that we own is private sector banks, right? Many people have asked. So it's a very interesting thing. 2021 Jan to December, what has been the biggest underperformer in our portfolio? It's not ITC, which is the most laughed about stock in the market. It's HDFC Bank. Why do we still own it? Obviously, there are problems in the bank. There's a transition going on. There is tech glitches. Every one of us on this call, I would imagine, has a current account or a savings account with HDFC Bank, and you've been tearing your hair around dealing with them. It's not been easy, but they are going through a transition. Through all of this, simple way, I think for a bank, if I was to think about financials, I think about the asset side and I think about the liability side. The asset side for me effectively has to do with the cost of capital. How do I acquire cheap cost of capital, as a result of which I can grow my liability side? How do I acquire cheap cost of capital? There is none other than HDFC Bank. Today, ICICI Bank is also in that space doing it well, and we own both. It's one of the reasons, and I'll come to it, why we don't own any NBFC in our portfolio, and I don't expect that to change. But on the liability side, how do I monitor my credit growth? So I want credit growth to pick up, and I want my cost of capital on the asset side to keep dropping, which basically means I'm paying out lower in FDs. So end of the day, monitoring the debit cards in issuances, though debit cards are passe maybe for most people, but debit card effectively means you are effectively opening up more retail accounts. So versus the rest of the industry, as you can see, HDFC Bank still is a leader. That's on the asset side. On the liability side, we talk about where is the credit growth coming from, which are the sectors where credit growth is coming from, and lending growth is picking up in India after a long time over the last 3 to 5 years, which is where you've seen financials actually underperforming. Why don't we own NBFCs? Just to spend 2 minutes on it, I think the fintechs coming over and taking over is not a disruption for banks. I think it could be a big disruptor for NBFCs, because what fintechs, I don't think fintechs will disrupt banks. I think fintechs will coexist with banks, giving them better penetration and better distribution. And what was that? Who took up that market share? According to me, it was NBFCs. So many of the smaller NBFCs, I think, will have scale up issues. And along with the fact that they don't have a cost of capital advantage, I think the growth could stagnate. End of the day, I think we want to be owning businesses which gain market share rather than stagnate in growth. Second is the financialization theme that I've been speaking to you about. I think it's very clear today that India is going through the early stages of financialization, be it in terms of brokerage accounts opening, what you can see the number of retail accounts getting open on Demat, or the inflows that are coming into mutual funds or ETFs. We're only getting started. I think this theme is here to stay. There are going to be beneficiaries in businesses where there is zero or pretty much very little competition, and these businesses are businesses that you would want to own in your portfolio for a longer term. They're because of it being in the capital markets, you are going to see volatility, which is going to be a part of it. But as long as cash flow growth keeps compounding, this will generate shareholder return. The third theme that I keep talking about is IT or IT services. I think it's a structural theme, be it in the form of new age tech or platforms that we own, or old age. They're no longer old age, but companies like L&T Technology Services or Infosys, which we owned in some of our older portfolios. I think it's a good trend to monitor IT sector hiring. Two trends that are picking up: wage inflation that is happening in the IT sector in a very aggressive way, along with the growth of actual number of employees that are getting hired on the ground, right? Monitoring this trend is also a good proxy to understand, is this trend cyclical or structural? In the next decade, India, I think one thing that I have been consistently talking about is over the next 10 years, India is going to outperform pretty much every global market. India is going to give extremely, we are going into one of the better bull runs that I expect in India over the next 10 years. Where like I said in the earlier part of the call, doesn't mean if we go into a bull run, we will not see volatility. I think volatility is part and parcel of the markets. The question is, how do you manage that downside and participate and increase your longevity in the markets, which is what has been the biggest concern for most investors, right? People come in 1 year, 2 year, 3 year, but how do you take them from 3 years to 10 years? And that's what we want to be doing in our portfolio, not coming out and saying we are the best return fund on a month basis or a quarter basis or a year basis. That's never been our aim, because end of the day, it's our money also in the fund, at every employee level and every partner level. So I think five forces in India coming together for the first time: three from the supply side, two from the demand side, which is the reason I'm extremely optimistic in India. One is being talked about. I just highlight it very quickly. We are at a decadal low in terms of interest rates. This has implications around how we save as a country and how we save globally. Yes, we'll keep talking about US increasing its rates. That noise will continue. It will pick up in 2022. But end of the day, from a company perspective, the cost of capital is low to borrow for me for the first time. Corporate India is delevered for the. I haven't seen corporate India's balance sheet across sectors this delevered in the last 20 years, right? What this means is it gives private capex to get set up by actually borrowing. Now, effectively, what this means is demand can take longer than expected because I have staying power in the game. When I have debt already and I borrow more, I don't have staying power in my game. Today, I have staying power from a corporate India perspective, right? This is happening for the first time in the last 20 years. Private capex, which is what matters to us, right? While public capex is good from a growth perspective or from a stability, setting the base perspective, what I care about is private capex. Private capex has grown 12% over the last 2 years. Why don't I use 1 year? Because 1 year is a low base. So what that means is we are already spending from a capex perspective much higher than pre-COVID levels, right? All of this is from the supply side. Supply side basically means from company spending, from infrastructure spending, from, let's say, cost of capital coming down. Now, this has to compound on the demand side. There's no point of setting up supply if I don't get demand. Now, what are those two levers that are helping us on the demand side today? End of the day, for a country to grow, I'm not talking about politics. That's separate. That's not under our control. What I'm talking about is you need good infrastructure. You look at US's growth story 30 years back. You look at China's growth story 15 years back. It came about because of good infrastructure being set up, and that we are seeing for the first time in the last 3-4 years. And I think that will take shape, be it in the form of roads or in the form of the infrastructure corridors that are getting set up, or in the form of better transportation, GST normalizing things on the transportation side. I think improvement is across the board. Lastly, from a demand perspective, consumers need to spend. You are basically seeing startups actually not creating paper money. They are creating real money on the ground. One of the things that I spoke to you about is 2020, $38 million of ESOPs was monetized, which means this money that is getting generated on the ground by the new gen India between 25 and 45. Today, that number was in 2021, that number is around $450 million. And I think that will compound, right? You're seeing VCs aggressively spend, you're seeing private equity aggressively invest. All of this, yes, capital comes at a cost. There is going to be ramifications of all of this, but as long this is what it takes to grow, right? So there is a demand side also coming in order to support the supply side. And I think this, all of these trends coming together makes us confident that the next decade will continue to belong to India. And the way we participate through that is to invest in good cash flow growth oriented companies, because that is a tried and tested way in order to compound capital. And that's what we follow at ITIS. Final thoughts before I end this presentation and open the floor. I think it's very clear the environment from an equity perspective is extremely conducive for a bottom-up stock picking. I highlight bottom-up stock picking. The fundamental shape of our portfolio is robust. What do I call as robust? I measure it quantitatively through cash flow growth. I continue to believe that India is the best geography from a risk deployment today. Public market is primed to be the best risk-adjusted return asset class, and investing in growth will continue to provide significant opportunities for us as we build or ramp up portfolios. So I'm going to finish the call with this.